Every year, quietly and without ceremony, the federal government extends an invitation it fully expects most people to decline, not through refusal, but through ignorance. In 2026, that invitation is worth $12,000. And the crushing irony, the kind that ought to keep a person awake in the small hours, is that the Americans most deserving of it are precisely the ones most likely to miss it entirely. You worked. For decades, you worked. You clocked in when you did not feel like it, deferred gratification when everything inside you resisted deferring, and trusted that the system you were paying into would eventually, in some modest way, pay you back. Congress, in a rare moment of fiscal acknowledgement, has done something approaching that. Buried inside the One Big Beautiful Bill Act of 2025, a piece of legislation whose populist name conceals its genuinely consequential interior, is a provision that the IRS formally calls the Enhanced Deduction for Seniors, and which financial analysts have taken to calling the Senior Bonus Deduction. For Americans age 65 or older, there is now an additional $6,000 deduction available on top of the standard deduction. For married couples where both spouses have reached that threshold, the number doubles to $12,000. That is not a tax credit, mind you. It is a deduction, a reduction in the income upon which you are taxed in the first place. The distinction matters enormously, and we shall return to it. But before we explore what this deduction can do, we must confront, with unsentimental clarity, what it cannot survive. Because this provision, generous as it appears on paper, contains within it a mechanism so precisely calibrated to frustrate the unwary that one might almost suspect it was engineered to fail. Quietly, invisibly, with the taxpayer none the wiser until the moment of accounting arrives and the damage is already done. Consider a couple. Call them Robert and Carol, both 67, retired in Ohio, the kind of people who did everything the financial culture told them to do. They saved diligently. They diversified. They collected Social Security. Robert draws a pension from 35 years of employment. Carol takes measured withdrawals from a traditional IRA they built together over a lifetime of discipline. By every conventional measure, they are managing retirement responsibly. And yet, in December of 2025, Carol made a single financial decision, a withdrawal from that IRA, entirely reasonable in isolation, entirely defensible in context, that erased their eligibility for the senior bonus deduction in one stroke. $12,000. Gone. Not because of recklessness, not because of greed, because of timing, and because no one had connected the dots for them before the calendar ran out. That is the story this script intends to tell. But to understand the mistake, one must first understand the architecture of the trap. The senior bonus deduction does not descend upon all qualifying seniors with democratic indifference. It phases out. For married couples filing jointly, the phase-out begins when modified adjusted gross income, the figure the IRS calls MAGI, exceeds $150,000. Below that line, the full $12,000 is yours. Above it, the benefit erodes. Too far above it, and it vanishes entirely. The threshold sounds generous. The reality is far more treacherous because in retirement, income is not a single number. It is a composite, a layering of Social Security benefits, pension payments, investment dividends, capital gains distributions, and withdrawals from tax-deferred accounts. And when those layers are stacked, the sum has a way of rising past what intuition predicts. Think carefully about what a modest retirement actually looks like in numerical terms. Suppose a couple collects combined Social Security of $38,000 per year. Add a pension of $28,000. Add $9,000 in mutual fund dividends. Add an IRA withdrawal of $30,000 to cover what life inevitably costs. A medical bill, a car repair, a visit to grandchildren. That is $105,000. But the IRS does not stop there. It folds into your MAGI calculation up to 85% of your Social Security benefit, depending on your total income. Suddenly, a couple who genuinely believed they were nowhere near the threshold is looking at a modified adjusted gross income that is uncomfortably, dangerously close to $150,000. One unexpected expense, one ill-timed withdrawal, and the deduction disappears. This is not a hypothetical. This is what happened to Robert and Carol. And it is happening right now to couples across this country who have no idea the trap exists. The threshold, for all its apparent generosity, is calibrated against a retirement income picture that millions of middle-class Americans actually inhabit. It is not the wealthy who lose this deduction. The wealthy were never eligible for it. It is the disciplined savers, the pension holders, the Social Security recipients who spent careers contributing to the system, whose composite income in retirement lands in precisely the zone where this provision becomes most dangerous. The cruelty is structural. The solution, however, is not. Knowledge, observed Francis Bacon in a formulation that has survived 4 centuries of intellectual fashion, is power. In the context of retirement taxation, knowledge is money. Specifically, the money that the IRS will not remind you that you are entitled to keep. The agency has no obligation to alert you to deductions you are forfeiting. The tax code imposes no duty of care on the government toward the taxpayer. You are presumed to know the rules. The question is whether anyone has ever actually explained them to you. Let us explain them now, because the strategies that protect your eligibility for the senior bonus deduction are neither exotic nor inaccessible. They require planning, deliberation, and the discipline to treat financial decisions not as isolated transactions, but as components of an annual income picture that must be managed holistically. The first of these strategies is what retirement planners call income smoothing, a concept so intuitive that its neglect is more a product of habit than ignorance. The principle is this: do not allow your income to spike in any single year when that spike will push you past the $150,000 threshold. If you need $60,000 from your traditional IRA over 2 years, take $30,000 each year rather than $60,000 in one. The mathematics are elementary. The tax consequences are anything but. Carol's mistake, the one that cost Robert and Carol their $12,000 deduction, was a $45,000 IRA withdrawal made in December. The couple needed the money. Their furnace had failed. A medical expense had arrived uninvited. Their accountant had long ago suggested that year-end lump sum withdrawals were a common and accepted practice. What no one calculated in that December moment was what $45,000 additional dollars of IRA income would do to their MAGI in 2025. The very first year the senior bonus deduction was available, their income crossed the threshold. The deduction evaporated. Had Carol taken $22,000 in late 2025 and the remainder in early 2026, they would almost certainly have qualified in both years, claiming $24,000 in deductions over 2 tax years. They claimed zero. The difference between those two outcomes was not a different level of wealth, it was a different level of information. The second strategy involves Roth conversions, and here the landscape requires particularly careful navigation. A Roth conversion, the movement of funds from a traditional IRA to a Roth IRA, is a fundamentally sound long-term strategy. Money in a Roth grows tax-free. Withdrawals in retirement are not taxed. For retirees converting in a period when current tax rates are locked in, as they are through 2028 under the One Big Beautiful Bill, the incentive to convert is real and legitimate. The trap, however, is this: the amount you convert in a given year counts as income. A sizable Roth conversion in the same year you are attempting to claim the senior bonus deduction can push your MAGI past $150,000 and eliminate the very benefit you were trying to maximize. These two strategies, the conversion and the deduction, are not independent. They are in conversation with each other, and managing them without coordinating them is the financial equivalent of solving half an equation and calling it mathematics. Now, if you have found what we are covering here valuable, and I suspect you have because this information is genuinely difficult to find explained plainly and without agenda, I want to ask something of you before we continue. Subscribe to this channel, not as a reflexive courtesy, but because the tax landscape facing retirees in 2026 is more consequential and more complicated than it has been in years, and you deserve a source you can trust to make it comprehensible. Every video we produce is built on one conviction: that you earned your money and you deserve to understand the rules governing it. If that mission resonates with you, subscribe now and bring someone you care about along for the journey. The third strategy is one of the most potent and most underutilized instruments in retirement tax planning: the Qualified Charitable Distribution, or QCD. For Americans who are 70 and a half or older, the IRS permits direct transfers from an IRA to a qualifying charitable organization. Without that transfer passing through taxable income at all, the donation does not appear in your MAGI calculation. It does not count against your threshold. It proceeds invisibly and efficiently from the IRA to the recipient institution, satisfying your charitable intent while simultaneously preserving your eligibility for the senior bonus deduction. In 2026, the annual QCD limit is $108,000 per individual, a figure that accommodates virtually any philanthropic commitment a retiree is likely to have. If you give to a church, a hospital, a university, or a community foundation, and you do so with post-tax dollars following a taxable IRA withdrawal, you are, in effect, paying twice for the privilege of generosity. The QCD eliminates that redundancy entirely. There is one further dimension of retirement income management that demands attention, and it involves Social Security, specifically the manner in which Social Security benefits interact with your tax picture in ways that continue to surprise retirees who have never been told the underlying mechanics. The income thresholds that determine how much of your Social Security benefit is subject to federal income tax were established in 1983. They have never been adjusted for inflation. In the intervening 4 decades, wages and retirement incomes have risen substantially, with the result that a formula designed to affect a small minority of Social Security recipients now captures the vast majority of them. If your combined income, defined as your adjusted gross income plus half your Social Security benefit plus any tax-exempt interest, exceeds $32,000 as a married couple, up to 50% of your Social Security is taxable. If it exceeds $44,000, up to 85% of your benefit is subject to federal taxation. The political choices embedded in that static threshold are a discussion for another occasion. What matters here is that the senior bonus deduction, when successfully claimed, can reduce your overall taxable income sufficiently to affect where you fall relative to those Social Security thresholds, producing a cascade of savings that extends well beyond the face value of $12,000. There is a principle in law, traceable to ancient Rome and still operative in American jurisprudence, that ignorance of the law excuses no one. It is a principle devised to prevent bad actors from pleading innocence by professing ignorance. Applied to the tax code, however, it produces a rather different result. It places the entire burden of navigating an incomprehensible system on the very people that system was ostensibly designed to serve. The IRS will not call you. Your bank will not flag your withdrawal as strategically inopportune. The brokerage processing your Roth conversion will not calculate what it means for your senior bonus deduction eligibility. You are expected to know. The question is how and from whom. Let us make the answer concrete. Because the most responsible thing this program can offer is not rhetorical flourish, but actionable guidance. A checklist, methodical and specific, that you can begin executing today before the 2026 tax year advances any further toward a point of no return. The first task is to estimate your projected modified adjusted gross income for the current year. This does not require precision. It requires reasonable arithmetic. Add your Social Security income, your pension, any dividends or capital gains distributions from investment accounts, and any IRA or 401k withdrawals you anticipate making. Then add approximately 85% of your Social Security benefit to account for its likely inclusion in your taxable income calculation. If the resulting number is comfortably below $150,000 for a married couple, your eligibility is in reasonable shape. If it is within $20,000 of that threshold, you are in a zone that demands deliberate management of every additional income event. The second task, before you take any IRA or 401k withdrawal larger than your usual amount, consult with whoever manages that account. Ask specifically how the withdrawal will affect your total annual income. Many brokerage firms provide free consultations for account holders. Use them not as a courtesy, but as a professional resource. The third task applies to anyone contemplating a Roth conversion this year. Do not finalize the conversion amount until you have calculated its effect on your senior bonus deduction eligibility. These two decisions cannot be made in sequence. They must be made simultaneously as components of a single income management calculation. The fourth task, for those who give to charity with any regularity, is immediate. Investigate qualified charitable distributions. The QCD is not merely a planning tool. For the charitably inclined retiree, it is a mechanism by which generosity and tax efficiency cease to be competing interests. The fifth task is calendrical. Mark a date in late October or early November for a year-end income review. By that point, the shape of your annual income is visible, your projections for the remaining months are reliable, and you still possess the ability to adjust, to delay a withdrawal, to reduce its size, to redirect a charitable gift through an IRA, before the calendar forecloses your options permanently. This deduction, it bears repeating with emphasis, is temporary. The law authorizing it covers tax years 2025 through 2028. Whether a future Congress extends or makes permanent a provision of this kind is a question no one can answer with confidence, and upon which no planning should depend. What can be said with certainty is that the years in which it exists are these years, and the couples who approach those years without a strategy are not merely foregoing $12,000 in a single tax year. They are foregoing potentially $48,000 in deductions over the full 4-year window, a sum capable of meaningfully altering the trajectory of a retirement portfolio. For those in the audience whose retirement income places them consistently above the $150,000 threshold, the specific deduction discussed here may not be immediately accessible. But I would urge you not to treat this as a reason to disengage from the underlying discipline this conversation is teaching. Modified adjusted gross income is not merely the gatekeeper for the senior bonus deduction. It governs your Medicare Part B premiums. It determines what portion of your Social Security is taxable. It triggers the net investment income surtax at certain levels. Every benefit, every threshold, every surcharge in the retirement tax landscape is keyed to MAGI. The habit of annual income management, of treating your income picture not as a series of isolated transactions but as a coordinated whole, is the most durable advantage a retiree can develop. Develop it now while the stakes are explicit and the numbers are in front of you. One final observation, and it is one that I believe the full complexity of this conversation earns the right to make. The retirement tax system in this country is not designed to be understood by the people it governs. It is designed by specialists for specialists, and its opacity is not incidental. It is structural. The consequence of that opacity is that retirees who cannot afford sophisticated financial counsel, or who simply do not know they need it, pay more than they owe, not because they cheated, not because they failed, because the rules were never clearly explained to them, and no one in a position of institutional authority was particularly motivated to change that. We intend to be the exception to that pattern, not by selling anything, not by promoting any product or financial instrument, but by making sure that the information which determines whether you keep what you earned is available to you, in plain language, before it is too late to act on it. Drop a comment below. Tell me, had you heard of the senior bonus deduction before today, or is this the first time this has crossed your path? Your answer shapes the content we build next. Share this with someone 65 or older who hasn't seen it yet, and remember, this is for education and discussion only, not personal financial advice. For decisions affecting your specific situation, consult a qualified tax professional or certified financial planner who knows your numbers, but at least now, you know the questions to ask.